Hi everyone, we're now going to take a look at the practice problems for Chapter 11. So we're on page 428 and 429 of your book. The first one we're going to look at is problem 11.1b. So Warner Company entered into the following transactions involving short-term liabilities. So we need to determine the maturity date for each of the three notes described above. So when they purchase on credit, replaced, okay. So on May 23rd, the company replaced the April 22nd accounts payable with a 60-day note. So we need to find that 60th day from May 23rd, which would be July 22nd. So remember, there's 31 days in May. So you want to subtract 23 from 31, that's 8. And then there's 30 days in June. So now you're at 38. You need to find the 60th day. So 22 more days would be the 60th day, so July 22nd. And you would go about that for the July 15th loan, which is 120 days. So now you're going farther out. November 12th would be the due date. Again, July has 31 days. So from the 15th through the 31st, 16 days pass. I better get my calculator out for this one. So 16 days. Then August has 31 days. September has 30 days. So by the end of September, 77 days have passed. October has 31 days. So the October 31st would be the 108th day. We need to know the 120th day. So 12 more days would give us the 120th day from July 15th, which would be November 12th. And finally, you would do the same type of progress problem, I guess you would say, from December 6th, the 45th the day, 31 days in December. So there's 25 days from December 6th through December 31st. We need to know the 45th or the 20 more days, which would be January 20th. So just a review on finding those due dates. But now we're on the other side. We're the ones borrowing. In number 2, they want us to determine the interest due at maturity for each of the three notes. Assume a 360-day year. So again, remember, to determine interest, you take principal of each loan. $4,600 is our first loan. Interest rate is 15%. That'll give us interest for an entire year, though. We only need to calculate interest for 60 of the 360-day year. $115. The July 15th note, you'll do the same thing. $12,000 principal, 10% annual interest rate, but multiply that by 120 days over a 360-day year to give us $400 of interest. And our final note, the December 6th, $8,000 times 9% interest rate times 45 over 360, or $90 of interest. Now, in number 3, they want us to determine the interest expense recorded in the adjusting entry at the end of year 1. Now remember, if a loan begins and ends, so it matures, so we borrow the money and we pay it all back in the same year, all the interest is an expense in that year because the loan only existed during that year. But if you look at Citibank, that loan, it carries over from one accounting year to the next accounting year. 25 of the days of interest occur in the year 1. The other 20 days of interest occur in year 2. So at the end of year 1, we have interest that has occurred, it's happened, but isn't recorded yet. How much? 25 of those 45 days. So $90 of interest represents 45 days of interest. So 25 of the 45 days of interest should be accrued as interest expense at the end of the year. And we'll see that journal entry in a few minutes. In Part 4, what's the interest expense recorded in year 2? Well, the only note outstanding is the one that was beginning on December 6th and maturing on January 20th. So the other 20 days of interest. So $90 represents 45 days. 24 of the 45 days would be $40 of interest expense. Now, let's do the journal entries. So, on April 22nd, when the company purchases $5,000 of merchandise on credit on account from Fox Pro, they'll debit merchandise inventory, increasing that asset, and increase the liability accounts payable. On May 23rd, when they replace the accounts payable from April 22nd with a 60-day note payable for $4,600, here's what happens. We debit accounts payable, decreasing it for $5,000, credit cash because they're actually paying cash of $400, and the other $4,600 is now a notes payable to Fox Pro. So we're just converting part of that accounts payable into a notes payable. That's one way of creating a note payable. On July 15th, they actually borrowed $12,000 cash from Spring Bank by signing a 120-day note, still a short-term liability or current liability. But now they're getting cash, so debit cash, credit notes payable. Now, the next day, which would be, I'm going to scroll back up here, the due date of the Fox Pro note, July 22nd. On July 22nd, we're paying back Fox Pro. How much are we paying them? Well, we owe them $4,600 and the interest we calculated up in step 2. So we're going to debit notes payable right here for $4,600, decreasing it, debit interest expense, and then credit cash, decreasing the cash because we're paying it. So that's how we handle a note when we're paying it off. Now when we pay off the bank loan we took, that second note up here on July 15th, we'll be paying that off on November 12th. There was $400 of interest on that. So we will debit the notes payable for the $12,000 principal, decreasing it, debit interest expense for the $400 of interest we have to pay, and then credit cash for the total $12,400 that we're actually paying. December 6th, they borrowed the $8,000 cash from Citibank by signing a 45-day, 9%, $8,000 note payable. So they're borrowing cash, so we'll increase cash, debit it, and increase the notes payable, $8,000 on the credit side. Now this is the only loan that is active at the end of the year. So that's why it's the only one we calculate in step 3 accrued interest at the end of year 1. So $50 of the interest has occurred by the end of year 1. So we must accrue it as an adjusting journal entry, debiting interest expense for $50, crediting or increasing interest payable for $50. Since the interest occurred this year, we have to record it as interest expense in year 1, that part of it. Now on January 20th, when the loan is due, we're going to pay off a total of, sorry for scrolling back and forth, but the principal plus the total interest on this loan of $90. So you see the credit there to cash of $8,090. We'll debit notes payable for the $8,000. We got to decrease that. We're paying it off. Now we're paying off the portion of the interest that we recognized last year as expense and showed as a liability. Decrease interest payable $50. And the interest that occurred on this loan from January 1 through January 20th is debited to interest expense, the other $40. So this is a great problem showing you how to determine due dates, calculating that interest again, taking a look at how we accrue interest if a loan begins in one accounting year and ends in another, and all the related journal entries. So please let me know if you have any questions on the first problem. The second problem deals with payroll. So 11.2b, Tavella Company's first weekly pay period of the year ends on January 8th. On that date, Tavella's sales employees earned $34,745, office employees earned $21,225, and delivery employees earned $1,030 in salaries. So that was their gross pays. The employees are to have withheld from their salaries FICA Social Security at a rate of 6.2%, Medicare at a rate of 1.45%. They give us the amount of federal income taxes, $8,625. They also have withheld $1,160 of medical insurance to pay towards their medical insurance and $138 of union dues. No employees have earned more than $7,000 in the first pay period yet. Calculate the FICA Social Security taxes and FICA Medicare taxes, and then prepare the journal entry to record Tavella's company's January 8th employee payroll expenses and liabilities, or their paycheck. So the first step is to calculate the FICA and Medicare. So what we'll do is add all the gross salaries together. $34,745 plus the $21,225 and plus the $1,030. So the total gross pay for all employees is $57,000. To calculate the Social Security we would withhold from an employee's paycheck, we'll multiply that by 6.2%. So the total Social Security FICA, $3,534. Medicare, you'll take the same gross pay and multiply that by 1.45%, $826.50. So that is how we calculate the FICA Social Security and Medicare. Now, to record the payroll, remember, gross pay is always your expense. So we're going to debit each expense separately. So sales salaries expense will be debited for those gross pays of $34,745. Office salaries expense for the office gross pay of $21,225, and then the delivery salaries expense will be debited for $1,030. Now, if there were no withholdings, we would have paid the employees $57,000, but we know the government requires employers to withhold certain taxes and remit them on the employee's behalf. And also the employer may allow for optional deductions that the employer has agreed to pay to various places, like for medical insurance or the union dues. So the first thing we want to do is credit our FICA Social Security taxes payable liability account for the amount of the withholding, because right now the company owes that on the employee's behalf. Same with the Medicare taxes. We'll credit a payable account, $826.50. The employee federal income taxes payable account, another liability, is credited for $86.25. So those three taxes are all federal taxes, and at some point the employer will remit them to the federal government on the employee's behalf. The employer also agrees to withhold from the employee's paycheck medical insurance, so they owe that on the employee's behalf, so they will credit a payable account for the amount withheld. And finally, union dues. Credit a liability account, union dues payable, because the company owes that on the employee's behalf to the union. Finally, if the employer is not paying the paycheck in actual cash on January 8th, They will credit salaries payable for the net, what they actually owe to the employee, which is the gross pay minus all of those withholdings, those deductions. When the employer pays the employees their net pay, they'll debit salaries payable for the $42,716.50 and credit cash. The second part of the problem wants us to prepare the journal entry to record the employer payroll taxes. Remember, these are separate additional items the employer has to pay because they have employees. Remember, they match what the employee pays for Social Security tax and Medicare. So whatever an employee pays out of their paycheck, the employer pays also out of their own pocket. And then there's the two unemployment taxes, state unemployment tax and federal, which is only calculated on the first $7,000 an employee makes. Well, none of the employees have reached $7,000 yet, so all of their salaries are to be used to calculate this tax the employer must pay. So this isn't being paid by the employee. It's not a withholding. This is an additional tax, but they use the employee's gross pay to calculate it. So we take the $57,000 gross pay times the state unemployment rate given of 5.4%, $3,078, and then the gross pay times the federal unemployment rate of 0.6%. So converting that to a decimal, 0.006 would be multiplied by 57,000 or $342. So the employer will credit FICA Social Security taxes payable again for the same amount, $3,534. They'll also credit FICA Medicare taxes payable again for $826.50. Credit state unemployment taxes payable for the amount we just calculated. They owe that, $3,078. And the federal unemployment taxes payable liability account for the amount we calculated of $342. The employer would then add those up, all those credits that we just increased the liability accounts for, and they debit an additional expense called payroll tax expense, $7,780.50. So these employees, just from this information, the total expense related to these employees is $57,780.50. Okay, so it is an additional amount. So if you've ever heard of people being paid under the table, that's illegal. And why is it illegal? The reason they're paying under the table or paying people cash and not giving them an official paycheck is to avoid these additional taxes and some other expenses employers may have to pay related to employees, like workman's comp. Okay, so that is how we calculate the employee's paycheck and record it in Part 1, and then the employer's payroll taxes and record them in Part 2. Okay, so that wraps up our practice problems. Please make sure you post any kind of questions you may have to the discussion board.